So the other day, I was watching a TV commercial, and it said that I can get guaranteed issue life insurance with no medical exam whatsoever for like, I don't know, like $100 a month, right? Why do I not pay attention to those kind of commercials?
Because they're not real.
All right. We're gonna hear more about that on the Loan Doctor podcast. I am Rich Brandt, the Loan Doctor with the Brandt Lending Team, and I'm here with my good friend Dwayne Merchant. Dwayne's actually the first guest we've actually brought back. Our episode was so good, the demand was so high that we had to bring you back again to talk everything life insurance. And as a reminder, Dwayne is a financial advisor with Northwestern Mutual who brings 20 years of experience to the financial services industry, has more than a decade serving clients at Northwestern Mutual. He earned his BS, that's bachelor's, not, the other BS, a BS in finance from Florida State University, go Noles, and holds both the CFP, Certified Financial Planner, and Certified Life Underwriter, CLU, designations.
Chartered life underwriter, but...
Oh, Chartered Life Underwriter? Thank you for clarifying. And he works for with individuals and families to create comprehensive financial plans that align with their life goals, focusing on retirement planning, risk management, and wealth accumulation. Tell our audience, what does that really mean? Like kind of make it basic. How does that, what is, how would you define that to like a person? Why do they want to talk to you?
Because I'm experienced and I'm a fiduciary when it comes to dealing with your wealth management and insurance as well.
Okay. How is wealth management different than me, going on E-Trade and just buying stocks that I think are going to do well?
Well, one, you're just getting professional advice, and one, you're doing it on your own. And I mean, listen, if you're a person that wants to do it on their own, and they can do it on their own, wants to deal with all that, if you have the time to do that as well, then, happy day. I mean, there's plenty of resources out there. If you're a person that gets emotional about investments, you definitely don't want to do it on your own. If you're a person that values your time, thinks your time's more valuable than you hopping online or doing something, you definitely don't want to do it on your own either. If you were
to kind of quantify in terms of hours, how much time you spend looking at the financial markets and stuff like that to analyze where you're putting your clients' money, how much time would you say that takes?
Me personally,
yeah,
I would probably just not as much as you think, because I let Northwestern Mutual, $300 billion company, do the heavy lifting.
Okay.
So they put hundreds, thousands of hours a week into the research and deciding where to put money, where to allocate, what kind of balances, overweight, underweight. And I leverage their resources, and I leverage that.
Okay. So I would imagine that the normal person wouldn't have thousands of hours to invest in time in a week to kind of make the same analysis that you would get working with a professional advisor like yourself.
Correct.
Okay. All right.
It's safe to assume, for sure.
Yeah. No. It's funny because we're all good at something. And at the same time, there are people who are better at what they do than we are at what they do. As a mortgage person, I look at numbers all the time, right? I see numbers, I see finances, I understand, tax returns and all kinds of stuff. But just because I do that doesn't mean I make good financial decisions when it comes to investing and it comes to insurance and protection and all that kind of stuff. So, which is why I reach out to somebody like Dwayne, or Dwayne specifically, to be fair, which is why I have Dwayne kind of take care of that stuff for me, because the fact of the matter is he knows way more about his lane than I do.
No one knows what they don't know.
Right.
And if you know that, would be very helpful.
I can I say that I used to say that all the time. You don't know what you don't know.
Absolutely.
And I think you get stuck. You get kind of pigeonholed because you think you know everything because you don't know what you don't know.
Correct. Absolutely.
Yeah. So everybody has a story, and you got into financial planning because
the movie Wall Street.
Nice. Okay. Like Wolf of Wall Street brought you.
Not Wolf of Wall Street,
Oh.
just Wall Street. The original with Bud Fox.
Those aren't the same movies.
Those aren't the same movie. No.
Okay.
Wall Street with not Bud, with
Michael
gosh,
Douglas.
Michael Douglas and I forget the actor's name. The other actor, his son.
Charlie Sheen.
Charlie Sheen. Yes.
Yeah.
And Wall
Who
Street.
incidentally wasn't in the Epstein files along with everybody else on the planet.
Oh, that's true. Yes.
You know?
Yeah, absolutely. That's true.
He did a lot of stuff except for that.
Yeah. I'm surprised we haven't heard from him on that.
Yeah, no, it's yeah.
He did everything else.
Yeah. But go ahead, Wall Street.
No, that was a great movie, and I was in college at the time, and decided to get into stocks, trading stocks specifically. So that's where I kind of cut my teeth back in the day. Is when I came out of college, I went to work for a brokerage firm, and began trading stocks.
Okay.
For clients.
Did you ever do like the penny stocks, like Wolf of Wall Street?
I did some pennies. Yes, that's kind of where I cut my teeth. That was it.
Okay.
Yes.
Okay. Wow.
Goodness, I don't know if I want to share that. Yeah, I could tell you some stories. I wasn't.
Go. I honestly, I think that'd be great. But go ahead, finish your answer, and then we'll talk about that.
Yeah, I could. No, so I went to work with one of those companies, and they went out of business. Like I think I was about 8 months into business.
Okay.
They had to close down, and everybody was leaving. I was the person. I don't know if you see the movie Boiler Room.
Yes.
And the kid didn't really know what was going on.
Right.
He just saw fancy cars in the parking lot.
Yeah.
And you had to be an account opener. You're just opening accounts.
Yes.
That was me.
Okay.
I was that kid for sure.
All right.
I wasn't in the stairwell trying to share information with the FBI or anything like that. It just happened, and I was like, "Hey, what's going on?" And so
funny.
I ended up having to leave, and I just ended up going to a small boutique firm, and
like a known firm that wasn't doing.
a small shop. Just another small firm.
Is
But they were
around?
more. You did what you wanted to do. They weren't underwriting, little penny stocks or things
Got
like
it,
that.
okay.
They were I was buying I started my first stock that I was really building a position in. I think at the time was Discount Auto Parts.
Okay.
And Home Depot.
Okay. Wow.
I was
Way back in the day.
Back in the day.
You were all in on Home Depot.
My
That's a good play. Turned out to
my
be a really good
ex-wife
play.
worked at Home Depot at the time, so it was.
Okay. So, all right. So, tell us a pink sheet story.
Oh goodness gracious! There was I remember there used to be, I forget his name, used to go up and down the aisles, buy water. So we had an issue that everybody was buying. That was the stock we were supposed to be opening on. It was called, I don't even know if I want to say the name.
Well, okay. All right.
Something Living Products or something.
Okay.
It was a water. It was a machine that made water out of air.
Okay.
So you could put it. I think they have those today, as a matter of fact. But you put in the quarter, and it would they turn the air. All it was really was a giant dehumidifier. In hindsight, it was the size of like a giant refrigerator. But the story was great. And the problem is that when you walked into the room where they had one, the room was so hot. And it was selling for like 50 cents or whatever, $1,
Right.
stock. Yes, that was buy water.
Okay.
And because they were bringing it public, and they brought it public, and like pink sheets or something. It ended up going up. I don't know what happened to it.
Right. But the money that people made on that was like obscene.
There was one that people made a lot of money on. It was like a little .com stock in
Right.
technology when the .com craze kicked in. There was, and I wasn't in the business at that time, but I just heard stories from guys that still owned or were buying those stocks, and one of them went from like 50 cents to $20. It was crazy. Yeah.
So how did you end up at Northwestern Mutual? What was it about the way they operate that made you want to, put your name behind it?
Well, their reputation, strength rating, very conservative, and in the insurance side is just a more conservative wealth management strategy.
Okay.
And I think I was pretty much the trading days were behind me. So
Okay.
now I'm just very conservative with my clients. they do the hard work and take all the risk with their daily jobs.
Right. Especially the people who are self-employed.
Correct. So that's where they get their best return.
Mm-hmm.
I'm looking to protect that money, for them.
Okay.
Whether it's, investing it the most tax efficiently and getting them the best return possible based on the risk that they're willing to take with that money, which is typically very low.
Well, I think that's why they call you the lifestyle protector.
Correct. Yes,
Yeah.
absolutely. Part of it, I guess. Yeah. Okay.
So what are you touched on it a little bit, but what are the potential investment returns of like whole life compared to traditional investments like stocks? Like why are people buying stocks? Why should people have whole life even though the returns are a little bit more conservative like you kind of talked about?
Yeah, I think we touched on that, but I don't use the word it's a comparison because they're not really comparable.
Okay. How come?
One is risk,
Okay.
right? Volatility.
Okay.
With the stock market, you have the potential for higher returns, but there's a lot more beta, a lot more risk associated in owning stocks. And not to say that you shouldn't. Everybody that is a long-term investor should have money in the market.
Okay.
Whole life is kind of the more conservative, foundational part of your portfolio. Money that's not going to have any volatility. It's not correlated to anything in terms of the stock market, real estate, stamps, Bitcoin, whatever. It's going to go up every month, no matter what.
Right. You touched on the word portfolio. What would you say what does a balanced portfolio look like?
Well, if you looked it up in the dictionary, it's going to say 60% stocks and 40% fixed income.
Okay.
Yeah, that's the traditional balanced, 60-40 model.
And whole life is considered fixed income.
Correct. It's going to be part of that fixed income model. And but that balance is going to have that equity portion is going to be in different asset classes, large cap, mid cap, international, small cap.
Right. Okay.
The fixed income portion is going to be spread around between cash, bonds, inflation protection securities.
Okay.
Whole life.
Do annuities fit into that fixed asset class, or do they? Or
they could, but they also could be in the stock market class.
Oh, okay.
If you have a variable annuity, which is invested in the stock market, versus a fixed annuity, which has a fixed rate, would be more on the fixed income side.
Does a variable annuity have more cost associated with it? If it's essentially buying stock, does a variable annuity have more cost associated with it than a stock account would have if you were gonna go that route? Not that I don't think that's something you recommend, right? Or
no, variable annuities are fine. So I think that's one of the big misinformation on variable annuities. That they have more expenses than your typical portfolio.
Right. Okay. I'm glad you're clearing that up.
They can. There's no variable annuity is really the same, right? What happens is you have a lot of riders that could be associated with them, that these step-up riders and things of that caliber that can make the variable annuity more appealing.
Okay. A step-up rider would be what?
Like a step-up death benefit or a step-up rider would be, on the anniversary of the contract, whatever that value is, the annuity or contract is locked in at that value. It can never go below that.
Got it.
But the only way to benefit from that is you have to annuitize the annuity, which it's a whole nother area, and turning into a stream of income.
So if I were to look at in a dictionary definition of annuitize, what would it tell me?
That would be in a stream of income. So there's a difference between annuitization and an annuity. Technically.
Okay, wait. So we're going down the rabbit hole again. This is why everybody liked the last episode.
All right.
So annuitized means I'm getting a stream of income.
Correct.
Right, like a monthly stream of income for the rest of my life or for a fixed amount?
Yes, you annuitized an annuity.
Okay, right, okay.
Yeah.
And an annuitization is what?
The same thing. Annuitization is you annuitize the annuity.
Oh,
so you can buy an annuity And and technically, yes, you're buying a stream of income,
Okay.
but
Got it.
not necessarily.
I got it.
So, I mean, you could put money into an annuity and invest it in a variable or fixed annuity, and you can decide at a later date if I want to annuitize it, and turn it into a stream of income, or you could decide I want my money back. I want to go and,
So you could you could just cash it in.
yeah, you can
Oh, I
you
didn't
can
even
take it
realize
all
you
out.
could do
Correct.
that. Okay.
Once you annuitize it or turn it into a stream of income, you give it to the insurance carrier,
Right.
and you say, I'm going to trade this, $1 million for $70,000 a year of income for the rest of my life.
Got it. Okay.
No, you can't have it back then. With a small asterisk, there are some plans that do give you a ability to get an accelerated payment stream if you needed an emergency, a one-time, one I work with specifically does. So if let's say you're getting $70,000 a year in year 2, and you have a 10-year guaranteed year plan, you could technically and say, hey, I have an emergency. I need to get. They'll give you 50% of those 10 years, whatever's left on it,
Okay.
up front.
Okay.
And you'll lower your income stream for the remainder of the 10 years. And then after the 10 years, it goes back to a normal income stream. So there's little things that you can do to get a lump sum money back emergency-wise.
After.
But
Okay.
typically, when you annuitize the annuity, you're just basically handing your money to the insurance carrier, and they're giving you a guaranteed stream of income for the rest of your life.
Now, what would happen if somebody has an annuity, like $1 million annuity, like you said, pays, and I didn't want to go down the rabbit hole of annuities, but somebody has, it's just fascinating because I don't understand it. And I'm assuming that other people probably don't either. And like I already had the misconception about the fees and everything. When if you annuitize, right, and have a $1 million policy and you're getting $70,000 a month, just using the numbers that we were going through, $70,000 a year. $70,000 a month would be great.
Yeah.
Thank you but $70,000 a year.
I'll take that all day long.
Yeah. But $70,000 a year, and let's say you pass away after 3 years, what happens to the balance of that annuity?
Okay, that's what I said. What I was kind of talking about before when I said you had a 10-year certain plan as part of that annuity.
Right.
It would pay for it. In that scenario, it would pay for an additional up to that 10 years. If you passed away in year, what'd you say, 2, 3?
2, yeah.
Then it would pay for another 8 years to your beneficiaries.
Okay, got it.
And then it would stop. When I annuitize for a client, I do not recommend, life only, unless they are really in need of the additional income and they don't really have any beneficiaries. But for the most part, if, let's say you and Giselle have an annuity and you annuitize it, I would make you do it either joint life,
okay,
or some period certain that's going to at least return your principal to you or Giselle, if something happens.
At the very least, I got you.
At the very least.
Okay, got you.
Because that's what you don't want. If I did use just you life certain for you, your life only, yeah, it may pay a little higher on a monthly basis because of that, but I don't think it's worth the risk unless you absolutely need that additional income and you're no beneficiaries.
I just don't know how much I love the guaranteed life because sometimes she looks at me funny, like I think she, and so you don't want that either. I don't need to give her motivation to get rid of me.
Did we do life insurance on you? Yeah, we do.
Yeah,
okay,
yeah,
don't tell her.
We do. All right. So because I do mortgages and I help a lot of first-time home buyers and move-up buyers acquire one of the major assets of their life in owning a home. It's also vitally important that we make sure that insurance, and that's why we work so well together, is that the other aspects of their life are really taken care of to help them in the event that something were to ever, insurance is all about the unexpected.
Correct.
So how does whole life insurance offer benefits beyond just sort of protecting the mortgage and things like that? Like talk about cash value growth.
Okay, yeah. So it has what we call now a accumulated cash value account.
Okay.
Which is the technical term now. I think it was updated from cash value. A lot of people like to just use equity or what's available in the policy that you can use to supplement your lifestyle.
Okay.
Whether that's a retirement lifestyle, emergency lifestyle situation, whatever. So I use the analogy of renting a home versus owning a home. Term insurance is like renting a home. There's nothing wrong with it. It's there to give you a roof over your head. It covers you for a certain period of time.
Right.
Very inexpensive for term insurance. But after 20 years, policy lapses. There's no equity, right? Whole life insurance is like owning a home. You're going to build up equity over time in the policy or accumulated cash value.
Right.
It takes time to get there, just like taking out a mortgage on a home. The first 5 years or so, you're paying a lot of interest, right?
Right.
And then whole life insurance, there's some heavy lifting in the first couple of years. That's where most of the expenses in the policy are taken out because they got to have money put aside because people do pass away.
Right.
But 20 years down the road, you're going to have a lot more than you put into it in cash value, typically, if you're with a good carrier.
Got it.
And you have a life insurance policy that won't expire.
Okay.
That's the big difference.
Let's say somebody paid off their house, and so they have this large equity in their home. Do they still need insurance?
Yes. I mean, I would say it depends.
Okay. All right.
I'm biased, I guess. Insurance.
Sure.
Yes, right off the bat. But in reality, it really depends on what their situation is.
Okay.
Do they still have beneficiaries?
Right.
Do they have a spouse? What is their lifestyle? How young they are, how old they are, a lot of factors. I mean, some of the planning, one thing people don't realize is a lot of households most households nowadays are 2 income, and that continues into retirement, even when your home is paid.
Right.
And that dual income could be from Social Security, right? And if you lose a spouse, that's one check gone, right? Or at least a third of it if, the other remaining spouse may be able to swap over to the higher income check, but you're still going to lose a chunk of income. So that could be something that you need to make sure that is replaced.
So we, as a mortgage vehicle, we have a mortgage that's called the all-in-one mortgage at North Point.
Okay.
And what an all-in-one mortgage does is it essentially blends the element of a mortgage with a checking account. And so you get this, it's kind of like a money stream, because every time you deposit money into the checking account, it reduces the principal balance on the loan, and you're able to save money, save interest.
Interesting.
The other thing, though, that to an extent, it could also work like a reverse mortgage, but in a more affordable way. So let's say I've got my house is paid off, right? And we'll just use $1 million. I have $1 million house that is now paid off. And now I've got this big equity, but it's impacting my quality of life because, I can't really do anything with the house. It's not giving me any more money. But if I were to take like an all-in-one and take, let's say, $500,000 out of the equity,
okay,
right? And then I take $250, and I'm going to use the $250 to improve my quality of life, right?
Okay.
So now I've got this. Now I've got this mortgage. So my house is worth $500,000 less, but I've got this other $250,000. If I use that $250,000 to fund a whole life policy, so that if something were to happen to me, my family would actually get the equity that I'm losing, that I'm sort of sacrificing, so that I'm able to spend the money, right, and have a better quality of life without sacrificing what I pass down to my kids. Would that work?
It could. I'd have to look at the numbers. I mean, it's very similar to, let's say someone sold their business for $10 million.
Right.
They would take a lump sum one time, $1 million, dump it into a permanent whole life policy.
Okay.
And that permanent life policy may be a death benefit of, $7-8 million.
Right.
And their beneficiaries are guaranteed to get that $7-8 million from the million.
Right.
And I'm just using some round numbers here. It depends on age and, health and all that good stuff. But now, there's a case where, hey, if I took that $1 million and I put it in an investment account, how long it would take to get to $8 million, pretty good time. But
well, then you also have the added element of risk.
Yeah, but you have an element of risk, and you have if something happened to you tomorrow.
Right.
you wouldn't have, $8 million. And I'm just using some round numbers there, but that's a strategy that,
Okay.
a lot of, for estate planning wise, when you exit a business and you're looking to have some money to pay, what it could be estate taxes or take care of one of your heirs, some of that type of thing.
Just kind of being in my world, like because so many people do reverse mortgages, and the cost of reverse mortgages tend to be high. I'm wondering if we'll have to look at the numbers, but I'd be curious to see if you could save the equity position and still get the funds needed to for that quality of life, but still have something to pass down. If the math kind of works,
I'd have to look at the math. I mean, typically when you're putting money into whole life insurance, there should be a life insurance need.
Right.
I know there's a lot of people out there that may just doesn't matter the size or shape of the hole that they're trying to fill. They just they've got a certain peg and they'll try to plug it anywhere. But if the numbers work, and they have an insurance need, it could be a possibility. Have to look at it.
I think a lot of times and it
depends on what their goal is, right? If their really goal is, if their goal is to just maintain their lifestyle for themselves, they just use the money. But if they really have, and I'm thinking out loud here, they want to make sure they maintain that equity for their, children, right? Or their heirs. They want to be able to pass something down to them. It could be a great way to protect that for sure.
Well, I think it's a balancing act. I think that's a lot of times people have a need for reverse, and what they're sacrificing is what their legacy. They're sacrificing their legacy. If the numbers work, and I think they will, which is why I keep talking about it, then you get sort of the best of both worlds. You get the added benefit of being able to access the resources that you need for a better quality of life or for emergencies that might come up without kind of taking away from what you're going to leave behind.
Correct.
Okay.
Yeah, if you have the income to, I don't know what the minimum payments would be on something like that for a HELOC or whatever you're talking about, taking the money out of the...
Well, so typically if you took enough money out, the payment would actually be coming from the money that you took.
Okay.
So yeah, it's...
Yeah, I'll have to, run the scenario, and we have to come back on another episode and go over the numbers.
Yeah, but I think we figured out the secret to a reverse mortgage, to avoiding a reverse mortgage and still having something to equity. That's to fall back on.
Well, we'll see how it works out.
All right. In terms of tax advantages, how do whole life policies compare to other types of investment?
Okay, good question. I know that tax-free.
Oh, that seems like a pretty good advantage.
That's sort of true in quotations.
Okay.
And that's the big, selling point for a lot of advisors out there. Like this, they use the word tax-free, but they just need to add the word, potentially in front of that or after that. If it's structured correct, it could grow tax-free.
What does structured correct look like?
So. And there's a section of code in the IRS. I believe it's 7702. Don't quote me on that, but I'm pretty sure I'm accurate.
All right. If it's not 7702, we're going to make sure Cole puts the right section for the IRS code.
I'm pretty sure it's that section, though, because there are a lot of people running around. They talk about retirement plan. Yeah, do you have a 7702 retirement plan? Or LIRP is the big term.
Okay.
Life insurance retirement plan.
Okay.
So, but how it's tax-free is that code specifically says, and paraphrasing, is that you can take your money out of a policy first versus the gains, which is the opposite of a retirement account or an IRA, right? So if you open an IRA, obviously it's all taxable because if you got a deduction, but if you opened a non-qualified IRA, let's say, and
non-qualified,
meaning that you didn't get a tax deduction for the IRS to open it.
Oh, like a Roth?
Well, a Roth would be no tax deduction, gross tax-free, but you had to qualify income-wise to be able to do that.
Got it, okay.
So, but if you opened a non-qualified IRA and you put money in there, $100,000, and it grew to $250,000,
mm-hmm.
the day one that you took $1 out of that policy, it's going to be taxable up to the amount of profits. So that first 150,000 of profits that you take out, that's taxable income.
Okay.
When you get to the principal of 100, that's your money. You didn't get a deduction. That you won't get taxed on.
Okay.
The 7702 says that you can take your money out first,
Okay.
not the gains.
Got it.
So structuring it correctly would be taking your money out first.
Got it.
And then taking the rest out as a loan on the policy. So you take it out as a loan, and you might have some little interest charge that you have to pay, but when you pass away, the death benefit will pay off the loan and then give the remaining amount to your beneficiaries, tax-free.
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 So the death benefit is tax-free. That's an interesting strategy. That honestly, that's so interesting. I kind of want you to repeat it.
I don't know if I can. If I was like Vince Vaughn moment,
that was really good. I mean, I guess somebody could hit replay or rewind, because it is a podcast.
I mean, that's why you typically take the money out as a loan when you withdraw money from your whole life policy.
Got it.
You know, because you want to keep the policy in force. You don't want to just say, "Hey, send me a check for all my money." It's going to lapse the policy, and you're going to have death benefit there remaining that you're going to lose.
Okay.
So you want to keep the policy in force. You take the remainder out as a loan, and the death benefit is always tax-free. But they take away whatever's owed in the loan. They take that out of the death benefit, pay off the loan, and they return the difference to your heirs tax-free.
So when somebody passes away and they have a retirement account, they have funds in the retirement account, and that money goes to the heirs, that money is taxed.
So it depends on what type of account. So it's going to be taxed. If it's an IRA, there is an inheritance rule. The government's going to get their money. That money doesn't go tax-free. Gosh, I'm going to have to brush off my CFP. That money doesn't go tax-free.
Okay.
Like if in an IRA, they did change the rules. It's called a stretch IRA. They inherited. So you inherit your parents' IRA.
Yeah.
You're going to have to take withdrawals, and you're going to have to take all that money out within 10 years.
And all that money is subject to tax.
Yeah, that money is subject to tax. Your income tax.
Your tax rate.
Your current tax bracket.
Okay.
A lot of some of the wealthy, when they get an inheritance from their parents, are like, I don't want it, and they try to, give it to their kids or something to avoid having to pay because they're already in a high tax bracket.
Right. Oh, so you could give it to somebody else?
Yes.
Who's in a lower tax bracket?
We'd have to double check on that.
Okay.
Yeah, we're going way down rabbit holes.
Some
of these things, I got to brush
that.
up on. Goodness. Yeah. The government wants their money. So anything that you got a tax deduction on, Uncle Sam's getting their piece. There's,
Okay.
But traditional assets, there is no income tax to inherit. Now there's the inheritance tax, of course, but
right.
Now we're going way down rabbit holes.
We'll have to get Mark in here.
Yeah, exactly.
Our CPA. To answer some of those questions.
Mark and Rena.
And Rena. Oh, yeah. This question is, how does flexibility of adjusting investments differ from the fixed nature of whole life premiums?
Wait, who wrote that? What the heck? Read that again?
How does the flexibility of adjusting investments differ from the fixed nature of whole life premiums?
Listen, at the end of the day, don't adjust anything. You're steady Eddie. Make sure you're making deductions or investments automatically, dollar cost average.
Right.
And if you're trying to, I don't know why you would be adjusting the amount. If you're trying to do that, you're trying to time the market.
Right.
Don't do that.
Time in the market's bad.
That time in the market's bad.
That's weird. I wish I never heard that. I always thought everybody says time the market. That's great. It's easy. It's simple.
Absolutely.
Yeah.
So don't time the market. Just keep your payments steady. Dollar cost average. Start young.
That is
compounding
true.
interest, compounding returns.
So we talked earlier about a balanced portfolio, and I think this question was kind of leaning toward that. Really talking about what are the risks of strictly like doing investments and not having insurance protection.
If you're just doing investments, they're not going to typically provide the benefit. If someone passes away, that insurance policy will. If you have, you're investing $100 a month,
right,
and your account's worth $5,000. Or $100,000. That stops when they probably need a couple $1 million. So, I think that's what you're asking.
Well, sort of. So if we talk about investing and leaving a legacy and that tax-free benefit part, is that let's say that instead of having insurance, right, somebody went the route of investing and built a nice portfolio for themselves, right? And then they pass away. Now all that portfolio is taxed at whatever the person who's receiving it, their tax rate, right? 28, 30, could be, 35, 39% in some cases, right? How much more of a return would I have to have gotten in stocks to make that the better play than whole life? I couldn't even imagine
Well,
that
if you
you'd
pass
have to be
away,
super risky.
well, no, that's if you're talking about the death benefit, right?
Well, yeah. So the death benefit on a whole life policy is tax free, right?
Yes.
So if I'm buying stocks as a means to leave a legacy behind to my kids, but because that is taxed, think about how much better of a return do I have to get on the stocks? How much more risk do I have to take to get the same value on a whole life policy?
So you're not taxed on those investments.
What do you mean?
So, your investment
No,
account.
I don't know anything. I almost cursed.
So your investment account.
I think this is a podcast. I think I could curse.
Yeah, your investment account is not going to be taxed when you give it to your beneficiaries, unless it's a retirement account that you had a pre-tax deduction.
Oh,
so your typical brokerage account, I don't know if you're separating the two. I think a question that you're asking is something that you hear in the industry is buy term insurance, invest the difference.
Yes.
Maybe that's what you're talking about?
That's what I was talking about. Yes.
Yeah, it sounds like a Susie Orman thing, maybe.
Yeah. That's exactly what it is. Okay.
Okay.
So why is that a good or a bad strategy?
So it could be a good strategy.
Okay.
And, it's for someone for like Susie Orman that's writing books, and it's, basically got to be very cookie cutter, vanilla, that's fine. But, the person that's selling, the hottest vacuum cleaner that may stay a fad for the next year or two, and their income is substantial versus a brain surgeon that's going to have a high income for a long time, need different strategies, not cookie cutter, buy term and invest the difference type strategy. And there's been plenty of research proving that. It's the most recent was BlackRock had a research put out talking about incorporating annuities and whole life insurance. 2021 Ernst & Young came out with a report, and they did a Monte Carlo scenario. They basically took about five different strategies. They ran about 5,000 different scenarios for each one of them. Basically, they took like buying term, invest the difference, and they would do different interest rate environment, different returns, different death rates, different inflation environments, and then they did in term, invest some in term and buy term insurance, invest some and then buy some whole life. They did some with annuities, so they did 5 different scenarios. It's on the internet; you can look it up. And every one of them came down to give a better legacy, have better, higher income, higher wealth. You incorporated about 30% of your portfolio retirement assets into whole life insurance and annuities with the potential for increasing payments.
Okay. You said something that I say a lot in terms of like it depends. I say this as well because everybody's financial puzzle is like a snowflake. It's all a little bit different.
Correct.
And so many times people go on the radio or write books and stuff like that, and they give investment advice as if as it applies to everybody universally without exception.
Correct.
And that is so dangerous because the fact of the matter is what you really want is somebody who takes the pieces of your financial puzzle and gives you the best solution for what you do, which is what I do from a mortgage side. It's what you do from a financial side and an insurance side. I probably say it depends 10 times a day.
Yeah, correct.
Because
everybody's different.
Somebody calls me up and says, "Hey, my guy said he did this and he did that." And he said, "Well, that's great, except that doesn't work for you. Here's why."
And I've read their books. I mean, there's the one that's Dave. His last name rhymes with
Dave
Pansy.
Ramsey.
Oh, okay.
Sorry.
I wasn't going to say it.
All right.
I mean, I've read some of the advice, and it could be good, but I've come across numerous scenarios where, that would not be in the best interest, long term.
It's funny because I talked on an earlier podcast about a 50-year mortgage. They were talking about a 50-year mortgage, and
yeah, I wanted to ask about that.
Yeah, we can. But by and large, if you looked at the media and everything like that, it got panned everywhere, right? Panned, absolutely. And you know what? For the wrong individual, a 50-year mortgage is really bad. But if you stop and think about it, like right now, we already have 40-year interest-free mortgages anyway, or interest-only mortgages. Where people are taking out mortgages for 40 years and not paying any principal. Here's the thing: for the right person in the right situation, you talked about a doctor, right? If I had a doctor just coming out of medical school and now they're able to buy the house that they want because they can afford the payment, knowing that their income is going to jump and they're not going to keep making the minimum payment, right? Then a 50-year mortgage isn't such a bad idea. Just because it's not good for one person doesn't mean it's bad. It's not good for everybody. And just because it's good for one person doesn't mean it's good for everybody.
Correct.
Yeah.
Yeah,
Okay.
I mean, the 50-year mortgage, I was, intrigued me.
Yeah.
Because real estate's done well, of course. I mean, if you're just doing interest only, and your payment is less than what rent would be,
Yeah.
I mean, you're going to build equity without having to, pay down principal. You're not paying down principal, but you're still building equity.
Yeah, I think I mean, again, the 50-year mortgage is good. It's just not universally good, like the 30-year.
That's pretty much most
You know
scenarios.
what I mean? Most scenarios, right. One of the things that would happen with the 50-year mortgage is that where it would hurt in terms of the economy, it would hurt people moving up because they wouldn't have over that time. Like you in the house 5 or 10 years, now you're not building the same kind of equity. Yeah, the house is probably appreciating, but you're not building the same kind of forced savings that you would have.
Correct.
And so now it makes it that much harder for you to buy the next house because you've outgrown your starter home. And so then all of a sudden home sales stall.
And home prices have continued to go up. So you might be in a better situation than the person renting, though. I mean, just thinking at the top of my head, because you're still building some equity. Whereas if you're renting, you have it done. Yeah, I don't know. One of those things we got to crunch the numbers on again, I guess.
Yeah. We'll have to talk about that on the third episode. In fact, I think we might convert this to the Loan Doctor and Lifestyle Protector podcast.
Maybe, I guess. All right.
And have it.
But I think
the point, you back so often.
The point you make is that, every situation's different.
Correct.
There are some cookie cutter strategies that will work, but the bottom line is the more income that you have and that you make, the more you're going to need a more tailored, specific plan for yourself.
Right.
The one thing with those books, for someone that's just starting out, yes, open an IRA and buy term insurance. Happy day. Start early. But when you start making some money, seek professional advice.
It's as you were saying.
Even though you just got professional advice for free right there.
Right there. Well, I was actually just saying that if you're looking to books for financial advice, or you're looking to the internet or AI for financial advice, it's very, very dangerous because you're getting advice that isn't specific to you. And if you want to get advice that's specific to you, you need to go to a professional. Let me ask you this. When somebody sees you, do they get like a free consultation?
Absolutely, yes.
What does that look like?
Typically, it's a an hour-long, 45-minute, I would say hour-long introductory meeting.
Okay.
First
15, for free.
Free.
You give an hour of your time, which
For
I
free.
know is valuable.
For free.
Because when we play pickleball, you send me a bill. So you give an hour of your time for free. So go ahead, tell me more about the meeting.
So it's the first 15 to 20 minutes wise introductory. Getting to know each other. Kind of what your goals are. What your lifestyle's like. What you're going to get done. But a lot of it is going to be, fact finding. Obviously gathering some information financially, and what your 3-year, 5-year, 10 years plan looks like down the road. And yes, we'll put together a personal financial plan. I mean, usually start out with something that's about 5,000 foot view, right?
Okay.
Just to get you started. and we'll do that free. It will tell you, pretty much, hey, this is where you're at. If you have a goal in mind, this is how much money you need to be putting away to reach it. It'll show you scenarios where, if something happens to you, what your shortfall would be in terms of income need that you want to, maintain for your family. A lot of people will, be underinsured or overinsured. It'll say that. So, yeah, do that for free.
Okay.
And as a CFP, I know there is fee-based planners out there that will do a plan very comprehensive, and they charge you a pretty penny for it, and then send you to someone else like me to put the plan in place. But I'll do the plan for free, and then I would be the one that hopefully would be able to offer the solutions.
What now? If somebody was thinking about seeing you or seeing a financial planner, what are the kind of documents that they should be preparing themselves? Like, what should they be collecting so that they make sure they have available so that you can best help them?
The biggest piece of information is from their tax returns. That's going to shed light on everything, pretty much.
Okay.
It's like what you use, right? It's going
Yeah.
to be very similar.
Okay.
Right. I don't necessarily need the bank statements. You can give me a lot of that information verbally,
Right.
but I think the two biggest would be bank statements. Tax returns and a real budget.
Okay. Oh, a real budget. That part's real important.
Yeah, a
Right.
real budget, not the one that you think
You have
that you spend.
right.
And you think what your income is. There's a lot of that are self-employed that, have a good revenue amount, but they write off a lot. They have a lot of expenses, don't really realize, how much they're spending. Those are the two biggest pieces.
Do you or Northwestern Mutual have tools to help somebody figure out what their real budget is? Because I think
absolutely.
I see that a lot as somebody thinks their budget is this, and when they really crunch the numbers.
We have Excel spreadsheets galore.
Okay.
Those you can find online. You can, for sure. But we have them with, Northwestern Mutual at the top, and,
All right. Now I read something today about how debt is growing. I think 90-day lates have increased something like 18% or something.
Oh,
It's
really?
the highest it's
Okay.
been in years. Yeah.
Interesting.
And so one of the things I think it kind of got me to thinking that a lot of people. I think there's a lot of people who haven't started saving or haven't started saving enough. They know they haven't saved enough, right? And they know they haven't saved enough. They're not saving enough now. They're a little bit embarrassed, right? And they don't seek help, right? They don't seek that plan, and they just keep kind of living to the next moment. What do you say to them to get them to kind of to sort of say, well, it doesn't matter. This is a judgment-free zone. We're not looking at you and saying that you're 50 years old and this is all you have. That's not how you're looking at it. What do you say to the people who haven't been saving enough, who aren't doing anything, and they're afraid to see somebody because they're embarrassed?
Yeah, just don't be embarrassed. We don't judge anybody. I come across those people quite often.
Right.
There's no judgment. We're in the nest. It's fine.
Yeah.
You're not the only one. That's what it comes down to. Lifestyle has become much more expensive now, right? At the end of the day, we know it, and people are trying to maintain it or live up to the neighbor or that type of thing. That's one of the things I've talked about, with them a lot. Is when you find out really what you're spending the money on, that would be your first step. Take a look at that budget, and you realize how much money you spend going out to dinner.
Yeah.
And those type of things. That'll help. But yeah, there's nothing really I could say to get someone off the couch. But
if
I'm not a psychologist,
somebody's listening right now, and they're in that situation.
Call me.
Yeah.
Look me up. I'm on LinkedIn. Send me a message.
I got it.
I'm more than happy to talk to you. We can even do it virtually. No problem.
I think I think that's real important, because so many people live in this fear bubble.
Yeah.
And fear causes you to not do anything. and then it doesn't make the situation better or worse. If anything, it makes it worse. I've had a couple people, and I've talked about this before. Banks are where you go to borrow money when you don't need it.
Yeah, no,
when you do need it and you're desperate, it's much tougher to get.
absolutely.
And I think what happens is people wait, and people are afraid, and people and a lot of people, right? And when that kind of happens, you got to kind of fight through that.
Yeah, absolutely.
When you're considering a client's financial plan, how do you determine the balance between insurance and investments?
So really, it comes down to I always look at the insurance need,
Okay.
right, first, because I really think that's the foundation of your financial plan. Making sure that you have, because you'd be making a lot of money and saving a lot of money, and if you get hit by the proverbial bus, that all stops, right? So it's not really going to mean much to your family. So I do look at the insurance first, and whether that's term insurance or whole life, that's a whole nother discussion. That's based on budget. Most of my clients start off with term insurance, but if you can afford, once you get that in term insurance in place, I typically have them maxing out their retirement accounts first, or at least close to it, and then looking at whole life insurance. But it really just based on a budget and kind of what your insurance need is. I mean, if you have the smaller insurance need, then you can put more towards investments. But I definitely recommend getting the insurance in place first. I'm biased maybe, but I really think it's the foundation of your financial plan.
Got it. I was just thinking you were talking about like 401ks and everything like that, and I talk to people about we were just talking about our 401k growth in the company, and I outpaced everybody that I talked to.
Oh, nice.
Yeah, I can't explain how that was.
I don't know either.
That was a weird coincidence
Yes,
that happened.
I didn't help you
you don't give
because
advice
I'm
like
not
that.
allowed to. But if I was, a good job.
Yeah. Now, how often should somebody reevaluate their life insurance and their investment mix?
They should at least annually have a conversation.
Okay.
With their insurance advisor.
Got it.
It can be brief. It could be a 5-minute, just a check-in, phone call.
Okay.
But if you've had any material events, major life events, that's when you need to, make sure. That's whether marriage, birth of a child, right? Bought a home, sold a business, bought a business.
Right.
And just business growth, at the end of the day. If a business is doing super well, you might just need more insurance, whether it's for yourself because your lifestyle has increased, or it could be for you and your partners to maintain, a buyout in place for if something happened to one of you. That's a whole nother podcast, but yeah.
Got it. So what does the Dwayne Merchant team do to make sure that they're following up with their clients, to make sure that they're doing that annual review?
We bombard them with email.
Okay.
No, we don't. No, we don't. But we do send out, I've got a newsletter that goes out monthly.
Okay.
And on their birthday, they'll get a nice letter as well. But we do send out on anniversaries, a nice email reminder type of thing.
Okay.
I'll send out a personal email to my staff.
Okay.
Asking if there's any changes happened in their life, and if you need to have a quick conversation. If not, if you need anything, let us know.
What's a common misconception that people have about life insurance? Like whole life, not term, because I think people understand the difference. But
I think just that it's expensive in general. I mean, I think even for both term insurance and whole life insurance. I mean, you'd be surprised what $1 million healthy person can get. A healthy person can get $1 million term policy relatively inexpensive. So I know you opened with that question about the ads on TV or on the radio.
Yeah.
And there is a little bit of truth to some of those, but it's not for the dollar amount that you're talking about. But a healthy non-smoker male $1 million policy is, $100 a month,
Okay.
And you can fill out a questionnaire, a medical questionnaire, and there's the potential that you could be approved without an exam. But most of them, they have you fill out a medical questionnaire. They're going to search the prescription database, RX database, and they're going to look at the MIB, which is to see if you've had any hospital stays.
Okay.
If you've had none of those, there's a chance, you could get approved. But most likely they'll still request exams, which would mean labs.
Okay.
It's really kind of a hook to get you in, I think.
Okay.
At Northwestern Mutual during COVID, we were doing accelerated underwriting on a lot of people with no labs and no exams, just because of the safety aspect. And we would look in those databases to see if there's anything in there.
And at what age should people start looking at life insurance? I think you kind of touched on it earlier.
Yeah, we spoke about that. I think as early as possible. I mean, right out of the womb.
There you go.
Right out of the womb. So, I'm not kidding. So,
no, I got it. Guaranteed issue.
Guaranteed issue. So, it'd be great. I've got clients right now that, mid-30s that are fighting to get some good insurance, having some struggles, whether it be, obesity, alcohol, diabetes, those type of things, which creep up on you. But it would be nice if you were locked in at birth on being able to increase your insurance with no medical exam.
Right.
And that's what, offering a small whole life policy to, a child can do. I mean, I know it's a little bit morbid when you talk about life insurance for your child, but it's a gift of insurance. I just had this conversation with a client that was so happy that he did it for his son, and there's a tremendous amount of cash value in the policy right now, and the son was able to get an additional like $500,000 worth of insurance over the years with no medical exam, based on the health of when he was 2. So,
Well, this was outstanding information that I think is super helpful to a lot of people. It's really important it's especially important for like people who are buying their first home, who got into that home ownership. Then if you haven't already done it, the next immediate step, because really, insurance is probably even before you own the home. But if you waited until after you got the home, you got a home, you don't have insurance protection, that is the best time to start. So I appreciate you being back on the Loan Doctor and Lifestyle Protector Financial Podcast.
Yeah, absolutely. I think that's a good idea. Next week we'll invite a realtor on.
There you go. All right. So that's it. I appreciate you being here, Dwayne. And for everybody else who was listening, thank you for being in my waiting room.